Good afternoon. From the For the CME, this is Chris Robinson, Managing Director and Partner at the Cal Guy Group. I want to start off there. If you're looking for help with your trading or your hedging, look me up online, Chris Robinson. That's number one. And here we are. We're finishing the second week of April. Next week, we've got another USDA report, and I wanted to talk about the setup for that next USDA report in the grains specifically. The managed money continues to be very sold short, looking for lower prices. And we've had a couple good technical trades in the grains since that report. Specifically, I'm going to start with wheat. Wheat tends to take a lot of selling pressure, especially even if the traders are buy corn and buy beans, they'll sell wheat. So it always is kind of a receptacle for a lot of short interest. We've seen two times now since our recent contract lows where we've come back. We had about $1.04, $1.05 sell-off in wheat. We've come back almost exactly halfway. If you look at May wheat, take a look at that 477 to 480 area. So there's big resistance there, and you may ask yourself, well, why is that? Well, a lot of traders, bulls and bears, will look at that halfway back point. It's a very important type of retracement in all markets that you should look at, not just grains. It happens a lot in a wide variety of markets. So that's what we're seeing there in wheat. People stepping in and reselling that halfway back level. That's number one. Number two, you still have a record short in the corn from the managed money. The record short bet the prices are going to go lower. Corn has actually bounced back. It's trying to fight higher, but it has a lot of resistance. And what we would look at there is to see if corn could ever get back to around 380, 385 in the spot month. That would probably set off a lot of short covering and could push us higher. So right now we're trading export news. We're also really anxiously awaiting this China deal, but we know this is April of 2019. We've been talking about a solution to the China trade deal going back to last year, last March. So I take it all with a grain of salt. I'll believe it when it gets done. But I think at the end of the day, a lot of people are expecting it to be very positive for grains moving forward. We'll see if that pans out. And finally, wrap it all up in a bow. Got to take a look at the U.S. dollar. You're going to hear more and more about the U.S. dollar approaching this 97-cent level. It's going to be a 2-year high. If you look at where we were, a year and a half ago, we were actually at about a 5-year low. So we've come higher now to about a 2-year high. People are going to start focusing on that, using that as a justification for commodities to be depressed. The idea being that while a higher U.S. dollar makes it harder for us to export our grains. If you really step back and look at it from a 30,000 feet view, however, exports were not that much better when we were down at 5-year lows than they are here at 2-year highs. So I would take that. It's kind of a simplistic, easy analysis. A lot of people will throw that at you. Oh, the dollar's higher. It's going to be bad for exports. I would say you have to go on a case-by-case basis to see if that actually applies. So that's all I'll be looking at today. Hope you guys have a good rest of the week. This is Chris Robinson, again, Managing Director and Partner at the Cal Guy Group. Look me up online.